Good day, students. This is Professor Alexander Buchholz coming to you live for Accounting 446, Nonprofit and International Accounting. We're going to basically go through our Chapter 13 today, Accounting for Legal Reorganizations and Liquidations, a combination of theory as well as some practicality as well in terms of financial statements. So, first, we're going to describe the history and the current status of bankruptcy and bankruptcy laws. I'm going to go through this really kind of at a higher level because we're going to focus in this course on the accounting treatment. We're not concerned terribly with the legal ramifications with some of these things. So some of the slides I will leave to you to look at your leisure, but we will not be going through each one. So the going concern assumption. Basic assumption of accounting, as we know, is that a business is a going concern unless we have evidence to the contrary. Bottom line, if we have something that is showing us that there's a going concern consideration, all of our companies are expected to survive. Okay? It's typically what we'll see what's a going concern if the retained earnings are negative. If current liabilities exceed current assets. If net income is basically negative for several years. This will be a red flag to us. This will be a red flag to us. And when we see this as a red flag, basically it means that there could be a problem with regards to the going concern. Again, some recent statistics of some of the American bankruptcies and their dollar amounts. Obviously, when a company does go bankrupt, it does have an impact on the company itself, the employees, the employer, as well as us, because if we have an investment in some of these items, then obviously we get impacted as well. So it definitely is something to keep in the back of your minds when you hear about bankruptcies. So again, if problems persist, if there are issues with regards to bankruptcy, if you're unable to pay your debts, then the question of bankruptcy can come in if a company becomes insolvent, meaning unable to pay the debts as they come due. The bankruptcy laws have been established in the U.S. to structure the process, provide protection for all parties, and ensure fair and equitable treatment. So let's describe the reporting actions that accountants should consider before a troubled company declares bankruptcy. So obviously, with some preliminary reporting considerations, bankruptcy, again, will struggle. Bankruptcy for a company means that management is struggling for months, even years to keep viable operations. The demise of a company might force an accounting reassessment. That's where we need to be sensitive, because if there is a bankruptcy, there is certain treatment of assets and liabilities that we're going to learn about in this chapter. Accountants must also monitor the asset goodwill. Entities now are required to test goodwill annually for impairment. Testing is more frequent if circumstances or events indicate that the fair value of the reporting unit is more likely than not to have fallen below its carrying amount. So let's look at the testing for impairment for goodwill. So if bankruptcy is possible, accountants should test for goodwill impairment. It is common for goodwill to be impaired prior to bankruptcy filing. A valuation allowance must be recognized to offset the impact of a future tax benefit, but only if it is more likely than not that the asset will not be realized. Accountants weigh all available factors to assess the need for having a valuation allowance to offset the financial effect of this tax asset. In the period before a possible bankruptcy, the likelihood of that recognition increases. So, in 2014, the FASB decided that a formal warning is necessary when bankruptcy becomes a possibility. This way, the decision makers who are on the outside would not be caught totally off guard. ASU 2014-15 describes the situations of uncertainty that basically require disclosures to inform financial statement readers of any going concern issues. This is not only something that management does, as well as a concurrence, possibly, by the auditing firm. So again, this is something that the auditors also are involved with because they need to basically opine on the viability or the going concern of their clients. So if now all of a sudden we see that there's a going concern consideration, it's going to impact the auditor's report. So again, some signals that I mentioned before: recurring losses, working capital, and current assets are less than current liabilities. Negative cash flows from operating activities, default on your mortgages or loans, labor difficulties, legal proceedings, loss of a key asset such as a patent or franchise, if substantial doubt exists about the ability to continue as a going concern, management must evaluate plans to avoid the possibility of failing to meet obligations as they come due. Two questions must be addressed. Is it probable that the plans will be implemented within a 1-year period? Now again, this is going to be 1 year from the date that the auditors have issued their opinion. So there has been kind of a little bit of a change there with the accounting standards. So again, if there is a change, if there is going to be a possible going concern consideration, the auditors are going to look 1 year, assess it 1 year after the date they issue. So again, if they issue the report June of 2017, they will assess it from June 2018. So that is kind of a newer standard that the auditors are doing. And number two, the auditors and management should look, will their plans, will these contingencies actually be enough to save the organization and not warrant a going concern consideration? And if there are doubts, we do need to make sure that they are disclosed in the financial statement footnotes. It actually needs to be in the footnotes to the financial. Full disclosure. Let's talk about the differences now between voluntary and involuntary bankruptcy. A voluntary bankruptcy is when the company goes to the court. They go themselves, they request the bankruptcy. The exhibits listing all assets and debt must be presented, and company officials must respond to questions concerning various aspects of the business's affairs. In an involuntary bankruptcy, creditors file petition with the court. Bankruptcy laws regulate the filing of involuntary petitions. If 12 or more unsecured creditors, 3 must sign, and creditors must meet minimum unsecured debt limits. Order for relief in bankruptcy. Being slow to make payments is not sufficient. So if the court does accept your petition, an order of relief is granted, which creates an automatic stay that halts against all actions against the debtor. Meaning that if bankruptcy is granted to us, the courts will prevent people from hounding you to pay. And it provides time for the various parties to consider steps that should be taken to limit losses. So maybe you have a vendor that you owe $3,000 to, and they'll come to you and say, listen, give me $1,000 and we will call it quits. We will relieve you of the balance of your liability because to us, something is better than nothing. The fourth learning objective. Identify the various types of creditors based on their status during a bankruptcy. The classification. Fully secured. The net realizable value of the collateral exceeds the amount of the obligation. These creditors are completely protected by the pledged property. Fully secured means they are protected, they're getting their money. Partially secured. The value of the collateral covers only a portion of the obligation. The remainder is considered unsecured. And unsecured means that all other liabilities are unsecured. The creditors have no legal right to specific assets. If there's anything left over after our fully secured and partially secured is left, then we may get something as an unsecured creditor. There are certain exceptions. Unsecured liabilities having priority. Administrative costs related to liquidation. All trustee expenses and the costs of outside accountants, attorneys will fall within this category. They have priority. Debts arising between the filing date, bankruptcy, and the issuance of an order of relief. Employee claims for wages earned during the 180 days prior to the filing and benefit plan contributions earned limited to $12,850 per employee during the same time period. Customer deposits limited to $2,850 per customer. Government claims for unpaid taxes. The fifth objective. Describe the difference between a Chapter 7 bankruptcy and a Chapter 11 bankruptcy. Liquidation versus reorganization. Under Chapter 7, the debtor's assets are liquidated and the proceeds distributed to creditors. So again, in Chapter 7, usually done for individuals, debtor's assets are sold, gone, business is finished, done. Or Chapter 11. This is a situation where the debtor is reorganizing and continuing operations. So again, accountants have different reporting situations depending on Chapter 7 or Chapter 11. So it's important that we as accountants be kept up to date. The sixth objective. Account for a company as it enters into bankruptcy. So the first thing is we'll have a statement now called financial affairs. So at the start of the bankruptcy proceedings, the debtor will prepare this statement. This schedule provides information on the company's current financial position to help all parties determine the actions to take. It is especially important to unsecured creditors to decide whether to push for reorganization or liquidation. Organization, Chapter 11. Liquidation, Chapter 7. Parties to the bankruptcy want information that shows what is the true net realizable value of the debtor's asset and the potential application of these proceeds to the various liabilities. The debtor's assets and liabilities are reported according to the classifications relevant to a liquidation. So we're going to now change the assets and liabilities section of the financials to show assets labeled as pledged with fully secured, pledged with partially secured, available for priority liabilities, and unsecured creditors. The debts will be labeled as priority, fully secured, partially secured, unsecured. The seventh objective: account for the liquidation of the company in bankruptcy, especially when using the liquidation basis of accounting. Usually in Chapter 7 bankruptcy, we go to a trustee. So an interim trustee is appointed by the court to oversee the company in the actual liquidation. They'll change the locks, they'll secure the assets, they will make sure that the financial records are up to date, possibly audited, get all the records, and voids any transfer of property made by the debtor within 90 days prior to the filing of bankruptcy. The committee of creditors will then go to the trustee concerning estate administration, and they'll make recommendations regarding the trustee's performance. It will submit to the court questions affecting estate administration. The selection of this committee is to help ensure fairness and to protect the creditor group's interests. The role of the trustee. The trustee must recover all property belonging to the insolvent company, preserve the estate from any deterioration, liquidate non-cash assets, and make proper distributions to the various claimants. The trustee might continue the operations of the company to complete business activities. And again, to accomplish the above objectives, the individual is the boss. They are the one who will hold all authority to get this liquidation process through. Another statement is prepared called the Statement of Realization and Liquidation. So again, we're now getting away from the balance sheet and income statement. We're going to new statements here. And this is going to show the account balances at the date at which the order for relief was filed, cash receipts generated by the sale of property, cash disbursements by the trustee, and write-off of assets in recognition of previously unrecorded liabilities. So again, the liquidation basis of accounting under the jurisdiction of FASB ASU 2013-07 is basically how we as accountants will follow the accounting treatment for liquidation. So with the liquidation basis is only applied when liquidation becomes imminent and there is only a remote chance that the plan will be blocked or the entity will return from liquidation. Proper approval of the plan is usually the point at which the liquidation basis becomes required by GAAP. So again, if you're just planning for liquidation, okay, but you're not actually with an approved plan. So again, if a company, let's say you're a not-for-profit and you wish to liquidate the company, you need to get Attorney General approval. That takes time. Once that comes through, then you will use the liquidation. Afterward, the company's financial reporting now includes a statement of changes in net assets and liquidation and a statement of net assets in liquidation. The statement of changes in net assets and liquidation includes a statement of change in net assets and liquidation to investors and other claimants, shows expected amount of net asset and changes that occur in that anticipated balance. An income statement or a statement of cash flows serves little purpose at this point. Must issue this statement of net assets and liquidation to provide all interested parties information about net assets available for distribution. On the statement of net assets and liquidation, assets are reported at the estimated amount of cash expected as a result of liquidation. Please note, it's not the same thing as fair value, meaning my accounts receivable might be on the balance sheet for $3 million. I may expect to only collect $1 million. In the statement of net assets and liquidation, the $1 million is what is shown on the financial. For the liabilities, no attempt is made to anticipate the legal release that may come from the bankruptcy process. So liabilities are still reported. We don't assume that anybody is going to forgive us. We keep them on the balance sheet. If you believe that you will have any costs of disposing assets, as well as close down attorney or accountant fees, you should accrue the estimated costs. What are some other characteristics of each statement? Even though liquidation is termed imminent, the actual time for the process can take over 12 months. Therefore, new statements have to be created periodically during that time. Any financial statements prepared before liquidation basis was necessary are not retroactively adjusted. So in other words, you're going to have two types of financial, pre-liquidation and post. The pre will show it on a normal GAAP basis with fair value of assets. The net asset and liquidation figures represent the amount reasonably expected to remain after all assets have been liquidated and all liabilities settled. Reported assets include items not previously reported. So internally developed intangibles, for example, can have a cash value for the company, even though it was recorded as an expense. All asset figures shown are reporting the amount the company expects to collect. So the recording of depreciation or impairment no longer necessary. Amounts are equal to the expected cash, so no further gains and losses. And again, adjustment of these balances of new information will impact the amount reported for net assets in liquidation. Liabilities remain reported at the amounts until they're settled. Disposal costs and operating costs should be anticipated and recorded as a liability. And equity accounts are no longer relevant because they're not even reported because they're not relevant to the liquidation. The eighth objective. Discuss the provisions that are often found in a bankruptcy reorganization. So now we're at Chapter 11. We're going to reorganize. So over there, we've got control over the company will be with the owners, not a trustee, with the owners. And it's going to really be a debtor in possession. Certain situations, creditors can take over as new owners. Suppliers might be able to maintain the company as a customer. Customers still may count on the company as a supplier. Employees may be able to keep the jobs that would have been sacrificed in a liquidation. The plan of reorganization has to be put forth within 120 days and approved within 180 days by the debtor in possession, unless the courts grant an extension. So again, when you're doing a plan of reorganization, you may propose changes in operations, plans for generating additional money, change in management, settle debts. Maybe we're going to sell the business. That might be our plan to reorganize. Acceptance and confirmation of the reorg plan requires approval by 2/3 of the dollar amount and more than 1/2 of the creditors who vote. Also requires approval by 2/3 of each class of shareholders who vote. Confirmation by the court. The court can force acceptance of a plan voted down, and the court can convert a Chapter 11 bankruptcy to a Chapter 7 liquidation. The ninth learning objective. Account for a company as it moves through reorganization. So several questions are raised. Should resulting income from continuing operations be differentiated from transactions connected solely with the reorg process? How are reorganization items identified? How should liabilities be reported? Some debts might not be paid for years and require payment of an amount less than face value. How do we present this information? Does reorg necessitate a change in the reporting basis of the company's assets? Is the previous carrying value still relevant? Income statement during reorganization. Gains, losses, revenues, and expenses of the known reorganization are reported separately from the normal operations on the income statement. Gains and losses on sale of assets if the sale is a direct result of bankruptcy proceedings as approved by the court. Significant professional fees can be incurred. Again, this is during reorganization, shown separately on the statement of net assets realized. Costs are recorded as expenses when incurred, regardless of the monetary amount. The balance sheet during the reorg. So again, a new entity is not created when a company moves into reorg. We still apply traditional GAAP. Book value. Current versus non-current classification is not applicable for liabilities, are subject to reduction by the court's acceptance of the plan. These liabilities should be reported separately at the amount of the claims. Liabilities not subject to reduction are all shown as current versus non-current. The 10th objective. Describe the financial reporting for a company that successfully exits bankruptcy as a reorganized entity. So again, in Chapter 11 bankruptcy, GAAP permits fresh start reporting with two conditions being met. Total reorg fair value of assets of the merging company is less than the total allowed claims as of the date of order for relief plus liabilities incurred subsequent. Company could not have continued as a going concern. It would have had a negative net. Previous owners of voting stock are left with less than 50% of the voting stock of the company when it emerges from bankruptcy, indicating that control of the successor company has changed. Fresh start accounting. Assets are always stated to the individual current value. Any unallocated portion of the reorg is goodwill. Liabilities are stated at the present value of future cash payments, and retained earnings is set to zero. Again, fresh start. So again, Chapter 11 bankruptcy, we're coming out of debtor in possession, and it's a new entity. A new entity. And that pretty much completes our discussion on this chapter. Again, very heavy driven on theory with this one, and we'll see that in future assignments that are given with the chapter. So again, I would suggest going through this chapter one more time and then completing any and all exercises that may have been assigned. Best of luck and all the best.